Hello, and welcome to this session on cybersecurity versus cyber insurance. I am Dr. Alaa Jabbar Almaliki, and today we are exploring a crucial intersection of technology and finance here at the School of Computing, Universiti Utara Malaysia. Consider this. Last year, the average global cost of a data breach reached nearly $4.5 million. When an enterprise faces an attack of that magnitude, the board of directors must determine if their primary survival mechanism is their firewall or their insurance policy. This choice creates immediate friction. Enterprise IT departments and corporate risk managers operate from a single finite pool of capital. Every dollar spent on upgrading firewall appliances or endpoint monitoring is a dollar that cannot be spent on purchasing higher limits for a cyber insurance policy. This diagram outlines our progression for today. We will start by examining the business problem of balancing these budgets. Next, we will analyze the technical requirements and policy distinctions. Finally, we will build a unified, security-first framework to resolve the tension. As computer science students, you must understand this financial tug-of-war. The code you write and the networks you architect dictate the financial survivability of the entire enterprise. Let's establish the foundational logic of risk transfer. Insurance underwriters deal in probability. Just as a property insurer will decline to write a policy for a building that is already engulfed in flames, a cyber insurer will decline to cover a network lacking basic defenses. We can categorize these policies by looking at this split screen. On the left is first-party coverage. This deals with the direct financial impact on your own organization after a breach. It pays for immediate expenses, like server replacement, forensic investigators, and data recovery. The right side represents third-party coverage, handling external liabilities. If a database is breached and identity stolen, it covers compensation, legal defense, and regulatory fines. These potential payouts can lead to a state of moral hazard. A company might assume that because they hold a comprehensive policy, they can afford to skip security upgrades or delay routine software patching. In reality, a cyber policy shields a corporate balance sheet, but it remains ineffective if the foundational IT architecture is left defenseless. Insurers actively monitor for this type of negligence. This has led to a major shift in the insurance market. Standard IT best practices have transitioned from suggestions into absolute mandates for coverage. This network topology shows the first of these requirements. Multi-factor authentication, or MFA, requires users to provide two distinct forms of identification before granting access. Underwriters now demand this as the baseline control for every enterprise endpoint. The second requirement is Endpoint Detection and Response, or EDR. While MFA guards the perimeter, EDR monitors behavioral patterns to isolate anomalous processes that slip past initial defenses. The financial consequence of these technologies is binary. Lacking MFA and EDR results in an automatic denial of insurance coverage. Without these controls, an organization cannot access financial backing. Let's test this concept. Pause the video and evaluate a hypothetical scenario. Imagine an employee at your firm reuses a weak password, allowing a threat actor to log in and steal a database containing 50,000 customer credit card numbers. Answer these two questions. First, which type of insurance coverage applies to the resulting customer lawsuits? Second, which of the two technical controls we discussed would have prevented the initial intrusion? In this case, third-party coverage handles the lawsuits, while multi-factor authentication would have stopped the intrusion. These technical controls serve as the mandatory criteria for an organization's financial risk transfer strategy. We resolve this dilemma with a proper sequence. It starts with a strong security posture, centered on MFA and EDR. This guarantees insurability, proving you actively mitigate risk. The financial payoff follows: lower premiums and comprehensive protection to survive a breach. For those studying computer science at UAM, this is the core takeaway. Technical security and corporate finance are linked. Your design of secure systems determines whether an employer can secure the capital protection they need. To answer the title's question, a robust cybersecurity posture must always come first. It is the foundation upon which cyber insurance is built. Thank you for your time, and I will see you in our next lecture.